The quest for highly effective and reliable day trading setups in today's volatile markets often feels like searching for a hidden treasure. Yet, an exceptional strategy exists, rooted in time-tested principles, offering a profound understanding of market logic and the intentions of its most powerful participants. This is not merely a trading tactic. It is a framework for perceiving the underlying dynamics that govern price movement, a method pioneered by one of the greatest market observers, Richard Wyckoff. His insights, developed over a century ago, remain remarkably relevant, providing a lens through which the seemingly chaotic dance of supply and demand becomes a coherent narrative. The methodology empowers traders to navigate the complexities of short-term price action, identifying high-probability opportunities that often elude those without this deep understanding. It moves beyond simplistic indicator-based approaches, delving into the very essence of market mechanics, allowing a trader to anticipate rather than react. At the core of Wyckoff's methodology for day trading lies a set of fundamental principles that explain how and why markets move. The first and perhaps most intuitive is the law of supply and demand. This law dictates that when demand for an asset exceeds its supply, prices will rise. Conversely, when supply overwhelms demand, prices will fall. In a state of relative equilibrium, prices tend to consolidate, moving sideways until a new imbalance emerges. For day traders, understanding this constant interplay is paramount. Every tick, every candle, every swing in price is a direct consequence of this battle between buyers and sellers. When the market absorbs a significant amount of selling pressure, it indicates strong underlying demand, suggesting an upward move is likely. Conversely, persistent buying pressure being met by an equal or greater amount of supply points to an impending downtrend. Observing volume in conjunction with price becomes crucial here. High volume on a price surge indicates strong demand, while high volume on a price dip could signal either aggressive selling or absorption by large buyers. The art lies in discerning which force is truly dominant at any given moment, especially within the compressed time frame of a day trading session. A rapid upward movement on increasing volume, for instance, signals strong buying conviction, while a similar move on declining volume might indicate a lack of genuine interest and a potential reversal. Recognizing these nuances allows a trader to interpret the market's immediate intentions, forming the bedrock for identifying profitable setups. This principle, while seemingly basic, underpins every advanced concept in Wyckoff's approach, providing a universal truth about financial markets that transcends specific assets or timeframes. The second foundational principle is the law of cause and effect. This law posits that a period of horizontal price movement within a trading range, often referred to as phases of accumulation or distribution, serves as the cause that determines the potential extent and direction of the subsequent vertical price movement, which is the effect. In simpler terms, the longer and wider an asset consolidates, the greater the potential for a significant move once it breaks out of that range. During accumulation, large institutions, often referred to as the smart money, are quietly buying up shares without driving the price too high, preparing for an upward trend. This sustained buying pressure, spread over time, builds the cause for a substantial effect, a strong upward markup phase. Conversely, during distribution, these same large players are selling off their holdings, again without causing an immediate price collapse, setting the stage for a markdown phase. For day traders, identifying these consolidation ranges is critical. The cause is built through the careful absorption or release of shares within a defined price channel. The longer this absorption or release takes, and the larger the volume traded within that range, the greater the energy being coiled, ready to be unleashed. Measuring the cause can be done through various Wyckoff tools, such as point and figure charts, which quantify the horizontal count of activity within a trading range to project potential price targets. This allows a day trader to not only anticipate the direction of the breakout, but also to estimate the potential reward, making risk management more precise. Understanding that every significant vertical move is preceded by a period of preparation allows traders to avoid chasing volatile price action and instead position themselves strategically during these quieter, yet highly significant consolidation phases. It's about understanding that market movements are not random, but are the logical outcome of prior activity. This leads directly to the third principle, the concept of the composite man. Wyckoff proposed that it is most helpful for traders to view the market as if it were controlled by a single entity, a composite man, who orchestrates market movements for his own benefit. This composite man represents the collective actions of large institutional investors, hedge funds, and other significant players who have the capital and influence to manipulate prices. He buys when the public is selling, during accumulation, drives prices up to attract retail buyers, markup, sells when the public is eagerly buying, distribution, and then allows prices to fall, markdown, to repeat the cycle. Understanding the composite man's intentions is key to successful trading. Day traders must learn to read the market's actions and anticipate what this powerful entity is likely doing. Are prices consolidating at a low level after a significant decline? The composite man is likely accumulating. Is there a sudden surge in price followed by a quick reversal from a new high? He might be conducting a test or an upthrust to gauge remaining supply before a markdown. By thinking like the composite man, a trader can align their actions with the smart money rather than being caught on the wrong side of their manipulations. This requires a shift in perspective, moving from simply reacting to price movements to understanding the strategic purpose behind them. It's about recognizing the footprints of institutional activity, often characterized by specific volume and price patterns, and interpreting what those footprints imply for future price direction. The composite man is always trying to deceive the less informed, and Wyckoff's methodology provides the tools to see through these deceptions. Finally, Wyckoff identified 4 main market phases that illustrate the complete cycle of the composite man's operations. 1. Accumulation. This phase occurs after a significant decline where the composite man begins to quietly buy shares from discouraged sellers. Price moves sideways in a trading range, often characterized by increasing volume on down moves, absorption of selling, and decreasing volume on rallies. This is the cause being built for an upward move. The range typically has multiple tests of support, where price dips below the established level only to quickly recover, shaking out weak hands. 2. Markup. Trend up. Once accumulation is complete and the composite man has acquired enough shares, he allows or actively pushes prices higher. This phase is characterized by higher highs and higher lows, strong upward momentum, and increasing volume on rallies. Retail traders often begin to jump in during this phase, feeling the fear of missing out, FOMO. 3. Distribution. After a substantial markup, the composite man begins to sell off his holdings to the eager public. Price again moves sideways in a trading range, but this time, volume may increase on rallies selling into strength and decrease on dips. This is the cause being built for a downward move. Resistance levels are tested multiple times, often with false breakouts to trap late buyers. 4. Markdown, trend down. Once distribution is complete, the composite man allows or actively pushes prices lower. This phase is characterized by lower lows and lower highs, strong downward momentum, and increasing volume on declines. Panic selling by the public often accelerates the markdown. For day traders, identifying these phases on shorter time frames, e.g., 5-minute, 15-minute charts, is critical for determining the prevailing short-term bias and potential turning points. A well-defined accumulation phase on a 15-minute chart, even within a larger daily downtrend, can offer excellent opportunities for short-term long trades. Conversely, a distribution phase on a 5-minute chart can signal a high probability short setup. The ability to correctly identify these phases allows a trader to position themselves in harmony with the dominant forces, minimizing risk and maximizing potential reward. Each phase has distinct characteristics in terms of price action and volume, and mastering their identification is a cornerstone of Wyckoff's approach. As we delve deeper into how these principles manifest in actionable day trading setups, it becomes clear that understanding Wyckoff is not just about memorizing patterns, but about grasping the underlying market psychology. It's about seeing the market not as a random walk, but as a carefully orchestrated campaign. To truly master this art and gain a comprehensive understanding of Wyckoff's direct insights into market analysis and decision-making, there's no better resource than his own timeless work. For those committed to elevating their trading acumen and internalizing the strategies of a true market master, How I Trade and Invest in Stocks and Bonds offers an adapted edition of Richard Wyckoff's classic writings. This book provides an unparalleled window into his thought process, detailing his methods for analyzing market movements, identifying opportunities, and managing risk. It's an essential read for anyone seeking to build a robust trading framework based on proven principles, offering practical guidance directly from the source. You can find a link to this invaluable resource in the description below, a step that will undoubtedly deepen your understanding of the market's true nature and how to navigate it profitably. Now let's reveal Wyckoff's #1 day trading setup, the Spring and the Upthrust. These are powerful reversal patterns that occur within established trading ranges, representing classic manipulations by the Composite Man to trap unsuspecting traders. The first step to identifying these setups is to clearly define the trading range itself. This involves drawing discernible levels of support and resistance that have held price within a relatively horizontal channel for a period. A valid trading range should show at least 2 touches of both support and resistance, indicating that both buyers and sellers have established their boundaries. The clearer and more defined these levels are, the more reliable the subsequent spring or upthrust will be. This range represents the cause being built, whether it's accumulation or distribution. The Composite Man works within these bounds, absorbing or releasing shares before making his decisive move. The essence of a spring is a deceptive move below a clearly established support level, followed by a rapid return of price back into the trading range. Imagine price bouncing off a support level multiple times, convincing retail traders to place their stop losses just below it. The Composite Man, knowing this, will then engineer a brief sharp dip below this support. This spring action serves several critical purposes. 1. Stop-loss hunt. It triggers the stop-loss orders of all the buyers who went long within the range, forcing them to sell and providing the Composite Man with cheap shares. 2. Liquidity grab. It traps early sellers who short the market on the apparent breakdown, providing further liquidity for the Composite Man's accumulation. 3. Testing supply. It tests the market for remaining supply. If price quickly reverses and re-enters the range on strong demand, it indicates that the selling pressure has been exhausted and the Composite Man has absorbed most of the available shares. A true spring is characterized by a swift and decisive rejection of the lower prices. Price should not linger below support but quickly snap back into the range, often on significant volume. This rapid recovery is the telltale sign that the Composite Man's manipulation was successful, and he is now ready to initiate a markup phase. Visually, it might look like a sharp V-shaped recovery, or a candle with a long lower wick that closes back inside the range. The psychological impact is profound. It creates fear among those who were stopped out and doubt among those who shorted the break, leaving them on the wrong side of the impending move. Conversely, the essence of an upthrust is a deceptive move above a clearly established resistance level, followed by a rapid return of price back into the trading range. This occurs during distribution phases or within a downtrend where the Composite Man aims to sell off his remaining shares at higher prices. Similar to the spring, the upthrust serves distinct purposes. 1. Stop-loss hunt. It triggers the stop-loss orders of all the sellers who went short within the range, forcing them to buy and providing the Composite Man with buyers for his shares. 2. Liquidity grab. It traps early buyers who go long on the apparent breakout, providing further liquidity for the Composite Man's distribution. 3. Testing demand. It tests the market for remaining demand. If price quickly reverses and re-enters the range on strong supply, it indicates that the buying pressure has been exhausted, and the Composite Man has successfully distributed his holdings. An upthrust is also characterized by a swift and decisive rejection of the higher prices. Price should not linger above resistance, but quickly snap back into the range, often on significant volume. This rapid failure to sustain the breakout indicates that the Composite Man's manipulation was successful, and he is now ready to initiate a markdown phase. Visually, it might look like an inverted V-shaped reversal, or a candle with a long upper wick that closes back inside the range. The psychological effect is similar to the spring, catching traders off guard and positioning them incorrectly as the market reverses course. These two patterns, spring and upthrust, are the primary tools the Composite Man uses to clear out weak hands and gather liquidity before a major move. Crucial to confirming both a spring and an upthrust is the analysis of volume. Volume provides the indispensable evidence of the Composite Man's actions. For a spring, when price initially breaks below support, it is often accompanied by a surge in volume. This high volume indicates the stop-loss hunt and the absorption of selling pressure by the Composite Man. However, the critical confirmation comes when price quickly returns into the trading range. This return should ideally occur on decreasing volume, signifying that the selling pressure has been exhausted and the Composite Man has successfully absorbed the available supply. A strong move back into the range on high volume also indicates conviction from buyers. What's most important is the character of the volume during the penetration and subsequent recovery. For an AC upthrust. Similarly, when price initially breaks above resistance, it is often accompanied by a surge in volume. This high volume indicates the stop-loss hunt and the Composite Man successfully offloading shares to late buyers. The key confirmation is when price quickly returns into the trading range. This return should ideally occur on decreasing volume, signifying that the buying pressure has been exhausted and the Composite Man has successfully distributed his holdings. Again, a strong move back into the range on high volume also indicates conviction from sellers. The interplay of price and volume provides the narrative of the Composite Man's manipulations. High volume on the false break signifies the activity of large players, while the subsequent low volume on the return into the range, or a sustained move back into the range, confirms the completion of their objective, clearing out one side of the market before initiating a move in the opposite direction. Ignoring volume when trading springs and upthrusts is a common mistake that can lead to false signals and costly trades. It is the market's internal thermometer, revealing the true conviction behind price movements. Without this confirmation, a simple breakout might just be a genuine breakout, not a manipulative spring or upthrust. The depth of this interaction between price and volume is what makes Wyckoff's methodology so robust and enduring. Having identified a valid spring or upthrust, the next critical step is to execute the trade with precision, defining optimal entry, exit, and risk management. For a spring, the optimal point of entry is not immediately after the price snaps back into the range. Instead, traders typically look for a retest of the previously broken support level, which now acts as new support from above. This retest, often called a backup to the edge of the creek, or a last point of supply, provides a safer, higher probability entry. During this retest, price should ideally approach the level on low volume, indicating a lack of selling pressure before bouncing convincingly. Another entry confirmation can be a sign of strength, SOS, a strong upward move on increasing volume after the spring, indicating that the Composite Man is now actively pushing prices higher. For an upthrust, the optimal entry point is analogous, a retest of the previously broken resistance level, which now acts as new resistance from below. This retest, often called a rally to the edge of the ice or a last point of demand, provides a safer entry. Price should approach this level on low volume, indicating a lack of buying pressure, before declining convincingly. A sign of weakness, SOW, a strong downward move on increasing volume after the upthrust, can also confirm the entry, signaling the Composite Man's intent to drive prices lower. Entering on these retests or confirmations significantly reduces the risk of being caught in a false recovery or rally. Stop-loss placement is non-negotiable and must be precise. For a spring, the stop-loss should be placed directly below the lowest point of the spring's false breakout. This allows for minimal risk exposure. If price revisits and breaks below this low, the spring has failed, and the trade hypothesis is invalidated. For an upthrust, the stop-loss should be placed directly above the highest point of the upthrust's false breakout. If price revisits and breaks above this high, the upthrust has failed. Proper stop-loss placement is the cornerstone of risk management, ensuring that potential losses are always known and controlled. It's not about being right or wrong on every trade, but about managing capital effectively over a series of trades. A tight stop-loss ensures that even if several trades go against you, the losses are small, preserving capital for the next opportunity. Determining take-profit targets requires a systematic approach. One method Wyckoff advocated is the horizontal count using point and figure charts. This method quantifies the width of the accumulation or distribution range, the cause, to project a potential price target, the effect. While detailed point and figure analysis is beyond the scope of a quick day trading overview, the underlying principle is to project targets based on the energy built within the trading range. A simpler, more practical approach for day traders is to use statistically probable targets based on the width of the trading range. For instance, a common strategy is to target 1x, 1.5x, or 2x the width of the range. If the range is 20 points wide, a trader might aim for a 20-point move after a spring. Another approach is to identify logical resistance levels above the spring, for long trades, or support levels below the upthrust, for short trades, from higher time frames or historical price action. It's often beneficial to scale out of positions, taking partial profits at intermediate targets while letting a portion run to a larger objective, protecting gains while allowing for maximum profit potential. The goal is to achieve a favorable risk-to-reward ratio, ideally at least 1:2 or 1:3, meaning potential profit is at least 2 or 3 times the potential loss. This ensures that even with a success rate of 50%, a trader can remain profitable over time. To truly elevate the effectiveness of the spring and upthrust setup, several factors for increasing efficiency must be considered. First, context of the higher time frame is paramount. A day trading setup, no matter how perfect, should ideally align with the dominant trend on a longer time frame, e.g., the daily or 4-hour chart. If a spring occurs on a 5-minute chart within a strong daily uptrend, the probability of it leading to a successful long trade is significantly higher. Conversely, attempting to trade a spring against a powerful daily downtrend is akin to swimming against the current, possible but far more challenging and risky. The higher time frame provides the prevailing wind for your sails. Aligning with it gives your trades a natural tailwind, increasing their likelihood of success. This multi-time frame analysis helps to filter out lower quality setups and focus only on those that have the backing of larger market forces. It ensures that the Composite Man's short-term manipulation is in line with his larger strategic objectives. Second, consistent confirmation by volume cannot be overstated. We've already discussed its importance, but it bears repeating. Volume is the market's confession. Continuously analyze volume patterns during the formation of the trading range, the false break, and the return into the range. Look for anomalies. Is the volume on the break genuinely high, indicating institutional activity, or is it merely average, suggesting a weak attempt? Does the return into the range show the expected decrease in volume for retests, or a strong surge for the initial snapback? Understanding different volume profiles, absorption volume, effort versus result, stopping volume, provides deeper insights into the composite man's actions and the true strength or weakness of the market. A spring or upthrust without compelling volume confirmation is merely a price pattern, not a high probability Wyckoff setup. It's the conviction behind the move as revealed by volume that separates a powerful signal from a trap. Third, psychological discipline is the unseen hand that guides successful trading. The Wyckoff methodology provides clear, objective rules, but executing them consistently requires immense patience and emotional control. Patience. Waiting for the ideal setup means resisting the urge to jump into mediocre trades. The market offers countless opportunities, but only a few are truly high probability. A trader must develop the discipline to wait for the spring or upthrust to fully form, for the volume confirmation to materialize, and for the retest entry to present itself. Impatience leads to chasing trades, entering prematurely, and ultimately losing money. Avoiding emotional decisions. Fear and greed are the two most powerful enemies of a trader. Fear can cause you to exit a profitable trade too early, or avoid entering a valid setup. Greed can lead you to hold on to a losing trade too long or take excessive risk. Wyckoff's approach, by focusing on the composite man's logical actions, helps to depersonalize market movements. By understanding that the market is designed to manipulate emotions, a trader can detach from the emotional roller coaster and stick to their plan. Practice and review. Consistent practice on historical charts and diligent review of past trades, both winners and losers, are crucial for internalizing the patterns and developing the necessary intuition. This builds confidence and reinforces the objective rules of the strategy. Understanding the historical context of financial markets and the ongoing saga of institutional manipulation can provide an invaluable perspective on these psychological battles. The grand narratives of Wall Street, the dramatic rises and falls, the cunning strategies of market titans, these are not just stories but lessons in market psychology and power dynamics that continue to play out today. For those who appreciate the rich tapestry of financial history and how it informs our present, there is a fascinating resource that brings these tales to life. The channel, Wall Street Memoirs, offers captivating insights into historical events, significant financial crises, and the legendary figures who shaped the world of finance. From the infamous market crashes to the daring exploits of market manipulators, this channel provides a unique blend of education and entertainment, shedding light on the human element behind market movements. Exploring Wall Street Memoirs can deepen your appreciation for the historical continuity of market behavior and the timeless principles that govern speculation. You can find the link to this compelling channel in the video description. So, why is this particular Wyckoff setup, the spring and the upthrust, considered unbelievable and so highly effective for day trading? First, it offers a high probability of success when correctly identified and executed. These patterns are not random occurrences. They are deliberate actions by the composite man to create liquidity and position himself for a significant move. By understanding his playbook, traders can align themselves with the smart money, drastically increasing their odds. The very nature of a false breakout, followed by a swift reversal, implies exhaustion of the opposing force and a strong commitment from the dominant side. This isn't guesswork. It's reading the market's true intentions. Second, it provides clear, objective rules for entry, exit, and risk management. Unlike many subjective trading strategies, Wyckoff's methodology offers concrete guidelines. Identify the trading range, look for the false break, spring, upthrust, confirm with volume, wait for the retest or SOS, SOW, place your stop loss precisely, and project your target systematically. This objectivity reduces ambiguity and emotional decision-making, making the setup repeatable and teachable. A trader doesn't need to guess. They need to observe, confirm, and act according to predefined criteria. This clarity is invaluable for maintaining discipline and consistency, especially in the fast-paced environment of day trading. Third, and perhaps most profoundly, this setup allows traders to act in harmony with the smart money, not against them. Instead of being victims of institutional manipulation, Wyckoff traders learn to recognize and capitalize on these very manipulations. The spring and upthrust are traps for the uninformed, but they are signals of opportunity for those who understand the Composite Man's game. By entering after the stop-loss hunt and liquidity grab, traders are essentially riding the coattails of the institutional moves, benefiting from their immense capital and market power. This shift in perspective transforms the market from an adversary into an ally, making the trading journey far more empowering and potentially profitable. It's about turning the market's inherent trickery into a personal advantage. In conclusion, Richard Wyckoff's spring and upthrust setup, meticulously applied within the framework of his broader methodology, stands as one of the most powerful and reliable tools available to the discerning day trader. Its foundation in the immutable laws of supply and demand, cause and effect, and the strategic actions of the Composite Man, provides an unparalleled depth of market understanding. By mastering the identification of trading ranges, recognizing the deceptive nature of springs and upthrusts, confirming with volume and applying rigorous risk management, traders can navigate the market with greater confidence and precision. This setup is not a magic bullet, but it is a scientifically robust approach that empowers traders to anticipate institutional moves and capitalize on them. It demands patience, discipline, and continuous study, but the rewards for those who commit to its mastery are substantial. We encourage you to delve deeper, practice diligently on historical charts, and integrate this powerful approach into your own trading strategy. The journey to becoming a consistently profitable trader is an ongoing one, filled with learning and adaptation. As you continue to refine your understanding of market cycles and the psychology of speculation, you will find immense value in the foundational works that have shaped our current understanding. For those eager to explore another classic that dissects market cycles and the psychology of speculation, even while acknowledging its original graphical limitations, W.D. Gann's Truth of the Stock Tape remains a timeless and invaluable text. While the original charts within the book may suffer from poor quality, the underlying text offers priceless insights into market behavior and the mental fortitude required for successful trading. It's a testament to enduring principles that transcend technological advancements, a deep dive into the very essence of market dynamics and human nature in financial markets. Find the link to this profound work in the description below. Embrace the wisdom of these pioneers and let it guide you on your path to trading excellence.